Welcome back to Nothing But Net Income, where valuations are the end game. I am your host, Adam, and like everyone else, we're going to be talking about PayPal. It seems everyone is making a video on PayPal today, and I will say, just kicking it off, I think my valuations are a little bit more conservative than the average person out there, given their prediction on where PayPal is going, but I will caveat that with saying I still think there is great upside from here. I've been a shareholder in PayPal for 3 years now, since 2020. I've been tracking the stock from even before then. It's been on my list before the pandemic. I finally entered Q3 of 2020, rode the stock all the way up to its highs. Probably looking back, hindsight's 2020, should have sold, and here I am today. But on that pullback that everybody's been saying is 80% down in the last 2 years, I've been able to increase my share count by 12 times what I originally had going into the position. So I do kind of regret not selling those original shares, but here I am. I've built this position out larger than I ever thought I was going to, because times change. Things go in and out of fashion, and people look at industries differently depending on what the macro environment is. I would say a little disclaimer here: unless you're a technical analysis wizard, a TA whiz, I would avoid looking at this chart, because honestly, it's just going to confuse you more than anything. And as Warren Buffett and many others have said, the stock market can stay irrational longer than you can stay solvent, and I think this is one of those stocks that went irrational to the upside and now is irrational to the downside, but that's where we take advantage, folks. I do think, like I said, this is a stock that went in and out of fashion, so it just goes to show you that you can overpay for growth, and here we're going to try to capitalize and underpay for that future. We're going to focus on those numbers, and is it now, at the current value of $59 a share, worth getting in a position now? And I will say, I think this video may age poorly, because I don't think we're going to stay at 59 very long. So I will say I did nibble a little bit early at both Teladoc and PayPal. As you might know, Teladoc was my last video. You could go check that out. I have averaged down heavily in these positions. So like I said, positions that were originally really good and have kind of soured. Now I am larger shareholders in those, and I have a cost basis that is much lower than my original purchase price. I'm not going to get too much into what the business does. I think a lot of people at this point have used PayPal, or there's plenty of other content out there telling you exactly what the business does. But let's look at what they looked like before the pandemic and now, and kind of compare, is this a dying company or not? So let's just first look at those revenues. In 2019, they had $17.77 billion in revenues. In the last 12 months, the trailing 12 months, they posted $27.52 billion. That is up 54.87%. Definitely a growth company when you can increase your revenues at that clip in that short amount of time. So that's one positive for the company. Looks like not a dying company. Net income, maybe not as impressive. Down 1.63% from $2.459 billion to $2.419 billion in the last year. And I don't love looking at just this metric alone. I think it takes things a little out of context, especially some large one-time purchases or expenses, if you will. And that is why I like to also look at the adjusted EBITDA, or earnings before interest, taxation, depreciation, and amortization. Like I said, takes out those one-time expenses and gives you a better look at the actual profitability of the core business itself. That's up 45.72% in the past few years, from $3.77 billion to almost $5 billion in the trailing 12 months. So again, another check mark that looks like not a dying business, even if net income has somewhat stayed a little bit flat, if you will. The cash equivalent has gone up a little bit, not anything crazy, just a 5.81% increase in cash and cash equivalents. So the business is not closer to bankruptcy or anything in the past few years. Shares outstanding has gone down by 6.39%. which is good. We want shares outstanding to go down. That means that now I own a little bit more percent of the business with the shares that I own. So that's down to just over 1.09 billion shares outstanding. And then finally, the last check mark, we get free cash flow here increasing from 3.8 billion to over 5.1 billion. That's an increase of 32% since 2019 to the last year, the last 4 quarters in 2022 and 2023. So pose this question to you. Does it look like a dying business? Does this look like a business that is going anywhere anytime soon? I don't think so. I think it's going to be sticking around. I think it's going to be with us for the long haul. Now, everybody thought we were going to be locked down for a long time, that we were going to be using e-commerce for everything, never going back to stores, and that's why the stock got crazy overvalued. But here we are in a day and age where the company might be a little bit stalled or stagnant, but I don't even think that that's a good word to use to describe it, because it's still a growing business in 2023. It will still benefit from explosive growth in e-commerce, in digital wallets, and in cryptocurrency. And I know crypto is a dirty word, but PayPal has been on the forefront of investing in some of the infrastructure there. And because PayPal is a trusted name, it has brought a little bit more trust to the industry for larger institutions. If they know that they can trust PayPal, maybe they'll actually trust a little bit of their portfolio to a cryptocurrency here, or their Bitcoin, Ethereum, whatever it might be. This is a healthy business in very growing industries. Let's look at some financial highlights. The total payment volume, the revenues, and the GAAP earnings, which is generally accepted accounting principles, are all trending up. This is all good news because we've been in times of high inflation in the past year or so, and a company like PayPal is seen as a hedge against inflation because they do their business in terms of percent of total volume or payments, and it's not like a flat dollar amount on their transactions. It's also a percentage that they take off the top. We want to see businesses that can really grow with a high inflation environment, and their model is designed to do just that. They also said for their forward guidance that they're going to have an EPS of $3.49 for the full year 2023. And that's 67% increase from last year's $2.09. One thing I will highlight here is that in their latest earnings calls in the last couple quarters, they've been talking about their transaction margins are compressing. They're getting a little bit smaller since it peaked out in Q3 of last year. So it's been almost a full year now since they've seen their highest transaction margins. And this spooks investors a bit. Usually you want a company that's being able to take more from the top line to the bottom line. But unfortunately, PayPal's margins have been experiencing some compression. I do think this is one of the main reasons that a lot of people are selling off this stock. They're pointing to this fact, and they're believing that the company is doomed because eventually they're going to go to zero margins or really low margins, and that's just not the case. Yes, there's other competitors in the space, but they'll never be obsolete because payment providers will always be necessary, and payment providers will always charge a little percent. So even if the spaces are getting more competitive and companies are taking less to the bottom line, the pie is still growing, and more players are taking more money from the total pie, from the total digital spend space. Can't and won't drop forever. These margins will turn around. They will bottom. People think the bottom might be in. I think that's more speculation than anything. But I do have confidence that they're still going to be able to grow their earnings even if margins still compress. I do want to just quickly say that one of the reasons those margins are compressing is Braintree. This is an acquisition they made when they bought Venmo, Braintree bought Venmo, and then they bought Braintree. I think this was back in like 2013, and this is now what you'd hear as the unbranded checkout. So PayPal owns the plumbing behind all those times you're trying to check out and you see a bunch of like pay with Venmo, pay with PayPal, pay with Visa, MasterCard. Like if you see those on a checkout, especially like Airbnb or like on Uber, that is Braintree, a company that has the service to basically make all these checkouts in the click of a button. And this makes checking out on all these websites so much easier. Everybody is using something like Braintree, if not Braintree, to make their business payments seamless. They're growing Braintree at a faster clip than the rest of their company, which is one of the reasons those margins are going down, because then they have another person in the loop taking a slight percent that they take home for the transaction. And this is what's concerning investors. I still, like I said, I'm not worried because the pie is growing. The digital spend space is growing. E-commerce is growing. If we're taking less home, that's not a concern to me. We are still growing both earnings and the revenues on the top and bottom line. Of course, always good to get into the risks of the company because we've already hit on, I think, the one that's driving the stock down the most. But the total debt is increasing of this company. It's doubled from $5 billion to $10 billion in the last 3 years, and that's because they acquired another company, Honey, trying to funnel traffic. And I think a lot of people might have used this before. They a lot of times have coupons, and they'll run through all the coupon codes for you. There's also Apple Pay, Google Pay, and others digital wallets taking away from that market share. I've already talked about this plenty, and people are concerned about, other payment providers working with other businesses like Stripe, Adyen, Shopify Pay, Square, and it's a competitive space. I'm not trying to say it's not a competitive space, but PayPal is still the front runner. PayPal is still the number one in this space. Payment providers is never going to be an obsolete business. There's always going to be a need to have a secure checkout, and a safe, secure checkout is something that both customers and merchants value very much. And also, we have flat cash flows, net incomes over the past few years. They're slowing and not growing, but also the revenues are still growing. And there's one other thing to be concerned about with an incoming recession, and that's just that total payment volume likely goes down. People just obviously spend a little bit less during a recession. They're not maybe going out and buying a TV on Amazon or whatever it might be. So you just got to be aware that total payment volume might go down in a recession as well. But also, a lot of times during a recession, a winner consolidates business and continues to keep growing because people remember that name. And if they're going to use anyone, they're going to use the one they trust. Finally, the last risk I identified is that there is a new CEO, Alex Chris. He comes from Intuit. He sounds like a really good guy, and for the job, he led a huge team at Intuit, the biggest business at Intuit, the growing business, and I think there is a new direction that he's going to take PayPal, and that's really to focus a little bit away from total user growth, which was the pandemic era, I guess, model for PayPal, was to focus on user growth and not so much focus on dollar per transaction or dollar per user, and that's where I think, since he's got small business focus, you can really trust PayPal to be your business if you're a small business. And he's going to really be working a lot, I think, with small businesses to focus and build products around the small and medium-sized businesses that do the majority of the revenues and transactions for PayPal. I also think he's going to be good as a products guy, new products coming in the future that we really haven't even assessed and put into our business model. So I do think we're moving from a company, like I said, focused more on, instead of user growth, revenue per user. So that's something I'm keeping in mind with my valuations. It means that revenues might not go up as fast as earnings per share. They're going to be focusing less on advertising to everyone and getting more customers, but they're going to be focused on getting more earnings out of the customers that they have and selling higher margin products. So that's why I have the 7% revenue growth and 14% EPS growth for the next 4 years. And the other piece of that is because that they are buying back their cheap shares, right? They're buying back incredible numbers of shares. If you look at that chart, it's just fallen off a cliff in the past 2 years. They're buying very heavy, and they've been authorized to continue buying back heavy on these shares, and that's why I think EPS will be outpacing revenues. One thing to use for comparison, just note here, Visa and MasterCard, two of the most respected payment providers out there, trade at roughly a 15 price to sales ratio and a 30 price to earnings ratio. My valuations for PayPal aren't going to be even close to these numbers. So take that with a grain of salt. Just remember, that's where the leaders in the industry are. Now, with a 7% revenue growth projection on PayPal, I'm using a 3 price to sales ratio. Remember, it was 15 for Visa and MasterCard. So this is a fifth. 20% of the value. We have a projected revenue, if they, next year should continue this 7% growth, finish around $29 billion. That puts them at a times 3 price to sales, a market cap of $88 billion, or 35% upside by the end of 2023. So that's 35% upside from today's market cap of $65.25 billion. You project that all the way out, continue growing at 7% till 2027, could be up to, at a 3 price to sales, mind you, a very, very meager, modest price to sales compared to some of the leaders, $115.79 billion market cap, or a 77% upside by 2027. Now, like I said, I honestly think this is a very conservative number. Let's look at how we could potentially do this with a earnings valuation instead of a revenue growth valuation. So 14% earnings growth. This is just a completely different way to think of it. I'm not looking at the price to sales anymore. I'm looking at a 20 price to earnings. Remember, Visa and MasterCard were 30 or higher. I think one of them trades at 35. So today, 2023, they're guiding for a projected revenue of $3.49. Continue growing that out 14% a year to 2027. That puts them at 2027 earning $5.89 per share. And remember, I think this is because they're going to be buying back shares and they're going to be focusing on higher margin products that they're selling to those small, medium-sized businesses along with the everyday consumer. You put a 20 PE on the 2027 $5.89 EPS. That puts the stock price at $117.80 by 2027, or a 98% upside from today's price of $59.42. Again, I don't think that these are completely outlandish numbers. I think these are really conservative. 14% EPS growth might be undershooting what they're actually going to be able to do every year. Some people, I've seen valuations of people expecting they're growing 50% EPS for the next few years. I don't know if that's true. I don't know if the stock buybacks are going to have that much of an impact. I don't know if the new products and the focus is going to have that much higher margin business, but something to consider. Given the industry, the payment industry not going anywhere, it's very consistent, predictable industry. I do think that this would be a clear, easy double in the next 5 years when the market itself, the S&P 500, usually doubles every 7 years. So even at a very conservative estimate, you're almost certainly outperforming the market with a stock like PayPal. I do appreciate you sticking all the way to the end of this video. I'm not a financial advisor. This is not financial advice. I do have a position in PayPal. I really appreciate if you like this video, you subscribe to the channel, comment down below what stocks you'd like us to make videos on in the future. Once again, my name is Adam. This is Nothing But Net Income. See you later.